Today on the Dynamic Growth Podcast, we're going to be talking about the debt ceiling, what it means for the broader macroeconomy, what it means for the global economy, what it means for the future of U.S. sovereign debt. And we're also going to talk about Nvidia's recent earnings. They added $200 billion in market cap based on an increase in expectations of $7 billion in revenue. Is that justified, and is now a good time to buy?
If you have any questions about your portfolio, investments, financial planning, insurance, anything financial, send us an email. You can find us at crosbyadvisorygroup.com. We've been putting this off for a couple weeks now. We probably should address this earlier because by the time this airs, we're probably there's a decent chance we're going to have either a conclusion to this or a disastrous end, depending on what happens. But I think it's about time we talked about the debt ceiling.
Yeah, the main reason I didn't want to do a podcast on it was because I thought people were making a bigger deal about it than what it deserved. Because ultimately, everybody knows like what the conclusion of this is going to be. They know that they're going to keep spending money. Like like we just said this before we got on the podcast. It's like the one thing that nobody can mess with the United States with is we spend more money than anybody. Not on a percentage of GDP basis. There are people that have higher debt to GDP than the United States does, but we are really good at racking up debt.
Maybe you can share with me a tidbit that you found most astonishing, but one of the things I found most astonishing when I researched this was that in 2011, Derek, when were you born?
98.
98. So you were alive on this earth. In 2001, the U.S. had a debt to GDP ratio of 42%.
Whoa.
Wow,
yeah,
right? I mean,
doesn't even sound real.
In 2021, it was 115%.
Yeah, that's insane. Yeah,
that's almost like a not admitting, you go to work in the morning and you stop by the convenience store and you pick up a case of beer, and by 3 o'clock in the afternoon, you look down and there's only 2 more cans left. It's at that point in time that you realize that you have a little bit of a problem. I think looking at that, man, do we have a spending problem?
Yeah, and then from a more what the Fed was doing, this is a really recent thing that not a lot of people consider. But the first time they did quantitative easing was in 2008. I'm pretty sure about that. I guess there's possibility that I could be wrong about that. But yeah, QE1 was in November of 2008, I believe. So when people talk about what's going to happen over the next couple of years, it's kind of a given at this point that they're going to have to do QE again, or at least that's what I believe. So it's funny how much that just becomes the standard of just spending trillions of dollars to bail out previous mistakes. That's something that's crazy to me.
So you had said that you were reluctant to do a podcast on this because you thought the chances of an actual default
pretty close to zero.
were pretty close to zero. But the United States has actually had a technical default in the past. If you do, so what a technical default would be is a temporary delay in the ability to make interest payments. Mm-hmm. And they had it in 1979. We had gone through the debt ceiling, and for a short period of time, there was a small portion of treasuries that were delayed in their interest payments. And in 2011, it was at the very end there, essentially, where they came up with a deal to raise that ceiling. But in two other cases that I found in the United States, there was a technical default, a delay because we had breached the debt ceiling.
You could also make the case that going off the gold standard was a default because it basically so if you think about it like a contract, like a debt contract, you're saying we'll be paid back in dollars, and then they changed what that meant to what they were going to be paid back in. So you could also argue that going off the gold standard was also a default, technical default.
For those maybe who have been under a rock here for the past month, what is the debt ceiling?
It's just basically how much the government can spend. They spend more than what they bring in revenue, and then they put this arbitrary cap on how much that they can spend, and then under the understanding that in the very short term they're going to have to raise it again, or I don't know what the justification is, but everyone kind of understands that it's going to get raised again. Nobody is under the the false notion that we're going to like dramatically raise productivity to a point where we could actually start paying this down, or that the government is going to stop spending. So all of this is just theater that they're doing. They're put on the show. Oh, the Republicans will be like, we're not going to let them spend any more money, and then the left is like, but we have to fund these programs, and then they both go to their sides after this is resolved, and then they're like, we won, we got the other side to cave. This is what happens every single time.
So the last time that they raised the debt ceiling was December 16th of 2021, and they raised the ceiling by $2.5 trillion. And they expected that that would get us through the middle part of 2023. So here we are.
Pretty close.
June, running up on June of 2023. So they were pretty accurate
right.
in that estimate.
Yeah. And then, like you said, we're recording this on Friday at around 1:30. There's been some optimistic reports today that they're hammering out the final details of a resolution. So by the time this comes out, it's probable that they will have raised the debt ceiling or come to some sort of agreement. But that was a big part of the debate early on, or at least a part about the conversation around the debt ceiling was the Republicans were going to try to raise it to the point where they would have to re-argue about the debt ceiling right before the election. So if they had some government shutdown under a Democratic administration, they could use that as political gunpowder, so to speak. And then, obviously, the Democrats didn't want that to happen. So that's probably where a large chunk of the debate is around this.
What is the consequences of a potential default in U.S. debt?
Yeah, so this is why I think that the probability of an actual default, where I'm not saying that the TGA won't go to zero, or they'll do like the whole like government shutdown thing, but as far as like actually not paying for maturing T-bills or paying the coupons on bonds, that would have like just dramatic ramifications that neither side is incentivized to do. So they're both incentivized to basically take it down to the last minute so they can look good for their base. But nobody on earth has an incentive. Even like our adversaries don't have an incentive for us to default. I mean, China owns a lot of our debt. And then just the ripple effects of defaulting would just be catastrophic to the global economy, just because the treasuries are the underpinning of everything, and the dollar is the global reserve currency. So the first thing that would happen is, this is interesting that I wanted to touch on. So in 2011, let me get this right. Sorry about that. I just wanted to get the right credit agency right. But it was Standard & Poor's S&P that downgraded the United States to AA plus or AA plus credit rating, down from AAA rated. So that was a big deal. It caused so this was just actually, I should have looked this up, but I believe that this was resolved. I don't think that they're currently rated as AA plus, but this was as a result of I have to keep referring to my notes here. The Budget Control Act of 2011. So it was kind of similar dynamics. I don't think it was a debt ceiling debate, but they issued new rules around debt. The Obama administration and Standard & Poor's downgraded the U.S. sovereign debt to AA plus, and this caused like a sell-off in stocks, and this was just a temporary small downgrade. So if the U.S. defaulted on the debt, they would probably get downgraded significantly. That would cause bond yields to spike. So as bond values, or as the yields on bonds spike, that means the value of the actual bonds go down. So we see this catastrophe going on in the regional banking sector and the financial sector in general, where these unrealized losses on bank balance sheets are driven by a decrease in the value of bonds because the Fed funds rate has been going up. So it wouldn't just be isolated to the U.S. financial sector. It would be basically all global central banks hold U.S. treasuries. The dollar would go down in value, so it would hurt the exports of foreign countries. Everyone would try to rush to dollars in the very short term. So there's just a lot of things that would hurt the global economy and not just here domestically.
You had mentioned that China was a large owner of U.S. debt. I believe they're number 2 on the list. Do you know who number 1 is?
It's probably us, right? Just the corporate
Actually,
sector.
well, that could be the case. As far as a foreign entity, it would be Japan as the largest owner of treasuries,
Oh.
U.S. debt. Derek, I think you're going to find this interesting. And everybody can go on to whitehouse.gov. I'm sure that's probably saved in most people's favorites.
Yeah, right.
You could go to the whitehouse.gov, and they put out a article out there, a little paper on this. It's called The Potential Economic Impacts of Various Debt Ceiling Scenarios. And what they tried to do is they took information that was published by the Congressional Budget Office and also the Department of Treasury, and they looked at the what-if scenarios if we were to actually default on this. And they broke this down into three categories. One would be brinkmanship, which is taking us right up to the limit of that debt ceiling. One would be a short-term default, and one would be a protracted default. And they put the numbers out there, and the numbers were quite interesting to me. I'm not going to go through all of them, but I'm going to look at jobs, projected jobs lost. Brinkmanship, they have us losing a little bit, 200,000 jobs is what they're estimating lost just because we go right up to the edge of the debt ceiling. A short-term default would result in 500,000 jobs lost, while a protracted default extending into the third quarter of 2023 would result in about 8.3 million jobs lost. They're looking at the GDP, and they're saying that a short-term default would cut GDP by about 0.5%, and if we went into a protracted default, it would result in a negative 6.1%. They have the U.S. stock market falling by 45% in the third quarter of 2023 if we are still in a protracted default, but they only have unemployment at 5%, which to me seems a little bit rosy, but
Yeah, right.
Who knows?
So the thing that strikes me with that stuff is like those are all like really short term. We're talking about over the next 3 months. Like so, none of those are like, except for the unemployment, yeah, which is probably wildly understated. And then like again, think globally because this would have global consequences. So let's just say in the most optimistic scenario, we go from like 3.6% unemployment to 5% unemployment. Like think about the global impact of that, of how many people globally would lose their jobs. It'd be astounding. But then that's only taking into account what it looks like from now until October. So then think about what it looks like over the next 5 years when if the U.S. gets downgraded significantly, and then there wouldn't be like this incredibly liquid market with U.S. Treasuries. So like now we can kind of just write blank checks, or we kind of have a blank check. We can spend on whatever we want to spend, and nobody really cares. There's always a constant buyer of those U.S. Treasuries. But if we were downgraded to the point like where there's actual risk of holding debt, because I mean, if we default, that would be an increase in the risk.
Sure.
Yeah, because now it's actually on the table that the next time this debt ceiling debate comes down the pike, we actually have to worry about it, and we actually have to take into that account when we're buying treasuries. Then there's going to be less reluctant buyers to basically fund everything. So it doesn't become let's go to debtclock.org and watch the number run up. It's going to be we actually have to cut spending, and we actually have to be fiscally responsible.
What's one thing that you took away from this research that maybe you had to come to grips with?
Yeah, I guess like the kind of the impact of the global scale of this thing, and then also like looking forward what that looks like, where it would be like kind of the actualization of what it means to be borrowing money. I think that would happen globally as well. Like it would also like it would be less likely that China has that similar money printer where they can just buy, or spend, and nobody really checks them, just like we do in the United States. It would actually have to, like, people would be less reluctant to lend to foreign governments because the United States is, like, kind of at the top of the global capital structure. It kind of works in the inverse, but if that top domino falls, I guess, it kind of would bring everything under it down with it, and that includes the entire stock market, for instance.
Yeah. So there's a strategy that if you are a life insurance agent and you sell whole life policies or you sell universal life policies, and if you're selling them because you're showing how the client can take tax-free cash value from that, and Bitcoiners actually do this too, or cryptocurrency people talk about this, where you buy, borrow, die. Meaning I bought the life insurance policy, I borrowed the cash value from myself, I pass away, and I'm still able to leave some sort of a death benefit to my beneficiaries. It seems to me, what became glaringly evident to me is that again, reading the Congressional Budget Office report, they estimate by 2032, Social Security and Medicare will compose over half of the federal budget. So, to your point, left unchanged, we're going to be in this situation, a couple of years from now, where we're going to be up against the debt ceiling and deciding if we're going to raise that or not. The only way out of that, it
deciding.
seems, yeah, the only way to avoid that, if the leaders of the country were truly interested in bringing that debt to GDP ratio down, if they were truly interested in reducing the deficit, they're going to have Social Security reform, and they're going to have Medicare reform. Because you can look at other aspects, but they're such small pieces of the pie.
Yeah, right. And then defense would be the other one. But then here, let me throw a curveball at you here. So the Treasury took the TGA. They're going to take it basically down to zero. I think that this was a high point. It was like $381 billion, and then they're going to take it down to zero. So now Janet Yellen says that she's going to refill the TGA to $500 to $600 billion. And now she has to, it's not rolling over debt, it's creating new debt at Fed funds at 5% and not Fed funds at 0% when we were rolling over T-bills in 2020. So now, let's say she wants to unload long duration bonds onto the market. So there's kind of two scenarios that are going to play out here. So if she decides to like unload long duration debt onto the market, there's going to have to be buyers of that debt. And if it's the private sector that's going to buy it, which it will be because the Fed's doing QT, so the private sector is going to buy it, they're taking on duration risk. So if you buy a 3-month T-bill, it's not going to move a lot. You're guaranteed to get your money back, or in quotation marks here. It's a risk-free return, and you're going to get your money back in 3 months with appreciation and interest. So on a bond, though, there's short to medium term volatility with the actual face value of the bond. So like what we saw with the regional bank sector, if those bonds fall in face value, even though if you held to maturity, you'd get all your money back, but you have to contend with the volatility in the short term. So you would have to rebalance your portfolio if Janet Yellen like unloads all these bonds onto the market. So you're going to take from stocks, you're going to take from other risk assets that you have, you're going to take from corporate debt or whatever. You're going to have to like restructure your portfolio to accommodate for this added duration risk that is going to be brought on. So then the second scenario that could happen is she could just unload T-bills onto the market. And like we talked about, there's like a structural shortage of T-bills because everybody is trying to plow money into money markets and just use us as a case study. We're buying all of these T-bills for our clients because they're paying 5% returns for a, quote, risk-free return. So if she does that, that is the most expensive part of the yield curve right now because it's so inverted. So the 3-month, I checked today, it was at like 5.36% interest on a 3-month T-bill. And then like the 30-year is like 3.2. I think it might be give or take a little bit there. But so she would be funding the government with the most expensive part of the curve. And then, so when you talk about this budget, if we're actually going to pay it off, so now we're rolling over debt that was 0% and now it's 5% if she were going to unload T-bills on the market. And then, so if you look at our budget, it's going to be defense, Medicare, Medicaid, Social Security, and that interest portion of the debt is going to be a massive chunk.
Wow. The thing that I think most people don't realize when they think about the debt ceiling, so the debt ceiling, basically being past the debt ceiling eliminates the Treasury's ability to borrow money, right? Am I correct with that?
Yeah, right.
Right. Why are they borrowing money? They're not borrowing money for new obligations. They're borrowing money for current obligations that are already underway. Mm-hmm. So this is why we end up in the same situation 2.5 years later, 3 years later, and people are always like, weren't we here before? Yeah, we were here before, but nothing's changed, right? The spending's continuing to go on. So my question to you, Jamie Dimon, who CEO of JP Morgan, said that he thinks that they should eliminate the debt ceiling, that this gamesmanship that the Republicans and Democrats display every year should just go away because it affects the markets.
It affects his net worth.
Yes, absolutely. What's your thoughts on that?
It's so this was a while ago. We had a conversation of if the government can print unlimited money, why do they tax you? If they can just fund all of their liabilities just by printing money, then why do they take 30% from your paycheck? There's a couple reasons. One of the reasons is just so you're incentivized to earn U.S. dollars. Like if you have to pay taxes in dollars, you want to have dollars. But it kind of like it's like a confidence game, I guess. I think is what it is. So it's like we're all playing this game where we know the debt is never going to get paid back, but the reason you buy a 30-year treasury, even though you get a real return that's negative, like there's just a couple things that we do that are irrational, but are just like under the assumption that I guess it's not. I guess under the
It's not
assumption
risky.
that we're gonna pay this debt back, which I mean, if you look at long term, that's what like the gold bugs and that's what the Bitcoin people talk about. But like basically all roads lead to we're gonna have to either massively devalue the dollar or we're gonna have to default or something's gonna have to happen. But the one thing that's not gonna happen is we're gonna pay this debt off. Like everyone is kind of just acting like this isn't a major problem, but it is.
Well, getting back to the point of, in order to pay back the debt, you would have to reform Social Security. And you would have
Everything,
to
yeah, yeah.
reform Medicare. Those are the two giants in the room that you have to attend with. No politician right now is willing to, most politicians are running why? Because they want to get reelected.
And
No
on
politician.
that time frame too, like your time frame, you only care
Yes,
about the next 4 years. Like why would you care about your great grandkids that are going to have to deal with this issue?
absolutely.
Yeah.
Yep. All right, good stuff. Anything that we left out that we should mention to the public here?
No, I think I covered everything that I wanted to cover.
I'm going to leave with one last thing because as you research this, then in your mind, I know our jobs are not to solve this problem, right? It's the leaders of our country hopefully can come up with a solution to that. But as I was researching it, in my mind begins to turn. Well, what are potential ways that we could pay this off? If you look at the largest sources of tax revenue in the United States, so this is from OECD revenue statistics. Individual tax returns result in about 42% of the total tax revenue. Corporate was 6%, which blew my
Yeah,
mind a little
that
bit, right?
was surprising.
Property taxes, 11.4. Consumption taxes, 16.6. So I'm going to stop you right there. Individual tax returns, 42%. Consumption tax, which is you and me buying things, right? And then getting taxed on that sales tax and other things, an additional 16%. And then the social insurance and taxes, which are going to be
And property
Social
tax.
Security.
I know you mentioned property tax, but then as far as like the consumer is concerned, they're also paying a property tax.
Well, you could argue that all of those actually are the individual.
Yeah.
Because the corporate at 6%, they get passed on to the you and I in the form of whatever we pay for the product.
And then let's throw in the quadruple whammy, which is inflation, which is also the hidden tax. So actually, I did have one more thing that I wanted to talk about. That another way that we could get out of this predicament is if we massively increase productivity to levels that we have never seen before. And a lot of people are speculating that will be because of AI. So I wanted to talk about Nvidia's earnings. We have to talk about Nvidia's earnings. So this is something that, do you have time? Are we still good to go for a little bit?
I do.
Good. So Nvidia, their year-over-year numbers were actually down, but the reason, basically, the stock added like $200 billion to their market cap in less than 24 hours, which was the largest single-day gain in the history of the stock market, the U.S. stock market. And that was driven by the expectations of next quarter. So they were talking about the orders that they were expecting to receive in this current 3 months that we're in. And they said that the Wall Street analysts missed it by $5 billion, which was like 50% off of what they were originally expected. So this caused this like massive expectations in the valuation. So if you were expecting them to make $5 billion or $7 billion, and then they come out and they're like, we're actually going to make $7 billion, they don't go up by $7 billion. There's like a multiple added to that because you expect future returns. Now, this does in no way justify what Nvidia's valuation is right now. It's like, I think it's close to 200. So I think a lot of that, any unexpected gains in their earnings or revenue has been priced in 10 times over if you're at 200 times earnings. But the market just keeps bidding up these AI related companies like Microsoft's up big too. Um, so I just want to get your thoughts on that, where AI is kind of like bubble mania. I wouldn't go so far as to call it a bubble, because I do think that there is real underlying value with stuff like ChatGPT and other AI technologies. But does it justify a 200 times earnings price multiple on a company that's down year over year in revenue?
Well, certainly not, right?
Yeah, right.
Certainly not. But
Warren
but there
Buffett's
are
like furious right now, probably.
there are periods of time. We always talk about over the long term, the market is rational. Over short terms, it can be irrational, and we have seen this many times in the past. Thinking about, and I'm not comparing this as identical scenarios, but there was a time not too long ago, Derek, when companies were adding the name blockchain to their name.
Yeah, or .com. The biggest one is the .com. Yeah,
the .com,
yeah.
Absolutely. And I think AI has that, a little bit of that. Like somebody would say, we're really getting into AI. Well, what does that mean?
Mm-hmm.
What does that mean for the actual? So I was actually in a meeting this morning. I'm going to put you on the spot a little bit.
Cool.
So Nvidia has shifted much of its business plan to artificial intelligence.
Data center, yeah.
Yep. So you could say Nvidia's into AI right now. Who is Nvidia selling to? Because they're not selling AI to you, the individual, necessarily, not directly. So who is Nvidia selling to?
Well, their largest segment is their data center business. So these are these big warehouses that are just running whatever program that they're being designed to run. So I don't know the names of the individual companies, but I just know that they're selling to companies that use a lot of computing power and a database somewhere.
So Microsoft is the owner of ChatGPT, or at least partial owner of that.
Yeah.
Is Microsoft, and maybe you don't know this, is Microsoft doing direct business with Nvidia?
Yeah, actually, I don't know that.
Interesting. Yeah, I think a component of it is, number one, Nvidia has always been, at least in recent years, it's always been an exciting company because they have the coolest chips, they have the coolest
best,
graphics processing units, and now that they're getting into this new phase of technology, which is erupting as far as popularity. I'm not surprised that their multiple is that high. Would I run out there and buy the stock right now? Not if I plan on doing anything with it over the next 6 months or so. If I plan on owning it for 5 years, then I might not be as concerned. But
you could make a compilation video of all the times that we talked about Nvidia in 2020, just because like their earnings were so astounding, like how profitable this company is, how fast they grow, how good the tech is. Like it is an incredibly well-run company as well. Like this is one that if you bought it a while ago, I would say keep it as far away from the sell button as possible. But if you're going to enter the trade right now, I would caution against that, just because, I mean, we are in a bear market. I don't think that AI is going to save us from the recession in the very short term. But so if we're in a bear market and a stock runs up 30%, adds 200 billion in market cap in a day, I don't think you want to chase that in a bear market. I think you're probably going to get a better opportunity if you don't already own it. But if you own it, stash that one away, because it's a really good company that you're going to want to own.
Don't we have to maybe look at what we're talking about if to say that we're in a bear market?
Yeah, right. Yeah, I mean, the market's run up so much year to date. But again, largely driven by 5 companies.
Yeah. The reason I said that is so if you look at the equal weight S&P 500, when I looked this morning, if you do a year-to-date return, it was slightly down for the year. And that is taking all those 506 or 8, however many companies are in there, and investing equally in all of them. Mm-hmm. If I look at the market cap weighted S&P 500, it was up roughly 8%. If you look at the NASDAQ, it's up 20, substantially. Yeah, largely to your point, because of a handful of companies that have driven this.
Yeah, that's what like people talk about when they say breadth of the market. Like, is there a good distribution of positive earnings? And I saw this thing on Twitter today. I'll cite it when I do the video. But it was like 94% of the companies in the NASDAQ have reported in the aggregate earnings growth or decline was negative 8%, but yet the NASDAQ's up, I think, close to 30% year to date, and it just in 6 months. So I mean, that is a concern, that the market has run up so much, and there's a lot of negative catalysts in the back half of the year. So it's going to be hard to justify chasing gains from here where valuations are. But I mean, if you bought everything at the beginning of the year, you're up handsomely.
We talk about this all the time, and I'm going to end with this, at least on my point here. The market, we talk about the market being expensive. Certain segments of the market are expensive. So I would want to caution investors to deciding to be in or out of the market. Mm-hmm. I think the safer way to do that is to look at your portfolio and say, okay, what percentage of my portfolio am I going to allocate to stocks? And if I'm an aggressive investor, that's going to be 60% plus. If I'm a conservative investor, that's going to be less than 20. And then be okay with letting that segment have a longer time horizon, and worrying about short to medium needs, financial needs with other asset classes. I think that's going to allow you to avoid the biggest mistake possible.
Yeah.
Now, if you're if you're somebody that just can't stomach with volatility, then maybe you can trim positions and do things like that. And certainly in our risk-based models, we will trim and add depending on where we are in the macro environment. But just something to consider. I don't think you want to be totally in or totally out of the market.
Yeah, I always just say if you're buying an individual stock, do a lot of homework and then just, unless the thesis changes, just don't sell it. Like just if you the reason for owning the stock is still in place and it's just short-term fluctuations in the market, just leave it alone. Just because of as case studies of people that will bring us their statements when they have an individual stock portfolio. And if you hold that thing for 10 years, just look at the gains that you get out of that account. It's just not possible if you're trying to trade in and out of certain names. You're just not going to be that good. Nobody's that good to get some of these returns. Okay, so here's a good example. I don't know the time. I think since the Nvidia's IPO, they're up over 10,000%. The market that beats the market by many multiples. It's you're never going to trade out, trade in, time the tops and the bottoms like that to the point where you're going to beat that 10,000% return. So the only way you could have gotten that return is if you just did the buy and hold strategy. So if you're buying individual stocks, do a lot of homework, make sure it is something you want to hold for a very long time, and then just buy and just monitor to the extent that your thesis doesn't change. But that's a proven profitable strategy.
I want to hit on one thing you said there because I think it's brilliant. If you look at a volatility asset or a risk asset like a stock, and you look at something that would be considered safe, like a treasury bond, those move in opposite directions as far as risk. What I mean by that, if I buy a quality stock, maybe not even a stock, if I bought the S&P 500, my risk actually goes down as the years go by. Because we've talked about this many times, the longer you hold it, your chances of a loss actually decrease. In the short term, your chances of a loss with a stock is substantial.
Sure.
After 10, 15, 20 years, it becomes historically non-existent if I'm buying a broad index like that. But the opposite holds true with that safe asset. If I'm holding that long-term treasury bond, which historically has not kept pace with inflation, in the short term, it's a little bit safer, right? Because it's going to display less volatility. But as I hold it, the longer I hold it, my risk of that money not spending keeping ahead of inflation actually increases. So something to consider as you look at your portfolio. That's why I think it's super important that you have long-term assets and you have short-term assets.
Yeah, diversify not just in sectors, but diversify across durations as well is a really good risk management principle. Do you have anything else?
All right, excellent. Derek, where can people find us on social media?
As always, thanks everybody for listening to the podcast. If you liked it, share, subscribe wherever you get your podcasts. Follow us on Facebook, Instagram, LinkedIn, YouTube at Crosby Advisory. Subscribe to the newsletter by going to crosbyadvisory.com/contact. And we'll see you guys next week.
Keep in mind that Crosby Advisory is a registered investment advisor in the state of Ohio, Texas, and Florida. At any time, you can request our forms ADV2A and 2B, which go into the business practices and qualifications of Crosby Advisory. Today on the show, Derek and I mentioned specific securities, and that is certainly not a recommendation for you to buy them or sell them. Do your own homework and make sure they are suitable for you. Keep in mind, investing involves risk, including the potential loss of principal.